Welcome back to my Bank on Yourself Wealth Builder series. We've been going over quite a few interesting topics over the last couple of weeks, and today I'm going to give you a little economics lesson. Now, before you tune off and tune out, I want to give you a little bit of background. I did not like economics in high school, didn't take it. In college, did not like it. I had the most boring professors ever. And as a business major, you have to take economics in order to graduate. So I had to muddle through it. And like I said, I did not like that class at all. I thought it was terrible. And I guess it just wasn't important to me at the time. I couldn't tie it into what was going on or anything like that. And I just want to fast forward a few years when I decided that I wanted to get into higher education. And I got sick of sitting in classes where the professors hadn't been in the workforce for many, many years, and they were up there teaching theory, and the stuff that was going on out there in the real world was not what they were teaching. And so that drove me bananas. And so I decided that I wanted to get into higher education, and I wanted to start teaching at some of the community colleges and the universities at our duty station. And so I walked in the door and, I had all my credentials and all of those things, and aced the interview, and everything was great. And they said, with your background, you can teach absolutely any class that you want, but to get your foot in the door, you have to start with economics. You've got to teach micro and macro economics. I thought I was going to fall out in the floor. And I'm like, no. Of all the classes, I hated it in college. I wouldn't be any good at that. I would be doing you a disservice. And they said, look, here's the deal. We can't get anybody to teach economics. So if you want to teach from our school, you're going to have to teach economics. So had to sit back and think on that for about 3 seconds. And I said, okay, I'm your gal. So I got in there and I started in studying. And like I said, I thought it was so boring, and trying to figure out how I could make it interesting for my students and myself. I mean, who wants to be sitting there, in a class when the instructor up there don't even like the subject, right? So I started pulling things that was going on in the economy at that time, and newspaper articles, and what was going on in the radio, and news around the world, and trying to tie that into our lessons plans. And before long, I became known as the econ queen, because like I said, every business major had to take economics, micro and macro economics. So I had students lining up wanting to take my class, and actually it became quite fun. So yes, you can make these dry, boring subjects interesting. So I thought I'd share that little background story with you so you kind of know where I'm coming from. I don't just sit around and geek out on what's going on in the economy or anything, but when it comes to investing, those are the things that, my ears perk up and I start listening, because I know what's coming. There's leading and lagging indicators that tell us what's coming next. Really, there are. You may not realize that. So one of the things I wanted to share with you that you may not be aware of is up until 2020, the United States had about 4 trillion US dollars in circulation. So wrap your mind around that. We had about $4 trillion in circulation. And up to that point, on average, you can go back and look, we was averaging about 3% a year inflation. That's what was considered normal. Okay. So we could expect every year that the price of goods and services would go up about 3% a year. And so that's why back in the day, you would always get a raise that was around that amount. Why? Because you wanted to keep your standard of living the same. You wouldn't want to be able to buy less than what you could afford to buy last year, right? So your wages had to go up the same amount as inflation, or you're losing purchasing power. Make sense? Okay, along comes 2020. And we all know kind of what happened in 2020, don't we? You remember the COVID and all of that stuff. All of a sudden, the United States started in printing money like it was going out of style. And they dumped, are you ready for this? Drum roll. They dumped $16 trillion into our economy. Now, back up. We had 4 trillion. That was how much we had. Now, all of a sudden, they dumped 4 times the amount of money that we had in our whole economy all at once into the economy. This would be like somebody driving through the streets of America with bags of money, just dumping it out, dumping it out, dumping it out. So there was 4 times more money in circulation. Well, what do you think that happens to the price of goods and services in your area if everybody knows that you got more money in your pocket to spend? That's going to raise the prices, right? Of milk, eggs, all of the things. The price is just going to simply go up. That's why I teach you guys that raising minimum wage is not the answer. Raising your job skills so that you're more valuable in the workplace, that's the answer. Not raising minimum wage, because all raising minimum wage does is it puts more burden on the employer to have to pay more out. And so the price of the things that they're selling, their products and services, have to be raised to compensate for your new raise. And then that gets handed down to the consumer. And so all that does, like I said, is raise the price of goods and services. Now I want to share something, how I'm going to tie this into the Bank on Yourself series is, have you ever wondered what the price of housing has done over the course of time? I'm fixing to show you. Hopefully y'all can see this. The average price of a house in 1940 was $2,900. 10 years later, in 1950, it was $7,300. So it about doubled in 10 years. In 1960, $12,000. 10 years later, not quite doubled. From 60 to 70, it went up $5,000, from 12 to 17,000. But yet, let's look here at 1980. In 1980, 10 years later, it went from $17,000 to $47,000, the price of a home. Now, if you ever wondered how those folks back in the day could afford to pay off their mortgage and all of those things that they did, and they would, have a fire and a ceremony and everybody would celebrate. Yes, they had better money management skills than what we do. I will hand you that, okay? Because we're terrible with money. But if you notice, the price of a house was less than 1 year's worth of income. Look at that. The price of a house was less than 1 year of income. Let's head on down the line here. From 1980 to 90, it went from 47 to 80, and then from 80 to 120. Look at this crazy pricing of houses. To $220 to $360,000 in 2020. Guess what it is right now? The average price 2023, $460,000. And I'm telling you all this because most everything in our economy does not keep up with inflation. But it seems to be the only asset class that has kept up with inflation is real estate. That's why we always say that it is an appreciating asset. And we're expecting this year, because what is happening is a lot of the COVID money and a lot of the moratoriums that went on with folks where they wasn't having to pay their mortgage and all of that stuff. A lot of those people, that has stopped. And they're going to be required to start making their payments. And we are expecting a ton of foreclosures and people in financial distress over the next 12 to 24 months. And I believe that there is going to be, right now, the housing market is probably pretty hot all around. Some people are trying to sell while their home prices are high. Some have doubled in 1 year. It's absolutely crazy. So I am expecting a big shift. I'm expecting that we're going to lose more than the historical average of real estate has only went down in 2007 during the worst crash ever. It went down 20%. And within 24 months, it was back up to where it currently was and then some. So the largest historical crash ever for real estate, we have lost 20% in value. So I am expecting, due to the economic factors that's going on in our economy right now, and some of the other things that you may not be aware of, is we've had a lot of building going on. And there is a lot of empty homes sitting empty that are not sold. So that's a lot of inventory that's not being tracked. And those investors are going to have to get rid of that inventory. And so what's going to happen is when you have a lot of inventory that you've got to get rid of, you're going to have to start taking down the price in order to sell, especially now that, the interest rates are at 7%. And some of you may be screaming, thinking that the young people can't afford it and all that stuff. You know what? I bought a house at 10% before, and we did it. There's been 18%, all kinds of stuff. Yes, you can do it. Yes, it's possible. No, it's not ideal. But in this economic condition, it's probably not a wise decision, because I think that there's going to be a shift. I think there's going to be a big price drop. And I think there's going to be a glut of inventory that's going to be available for sale through foreclosure and people needing to get out from underneath their houses. And so this is why we are scrambling and trying to encourage as many of you as possible to get on this train with us and start stockpiling cash and learn how to become a silent investor. For those of you who may not know what that means, is you simply leverage your cash, and your other piece to that is somebody like myself, we buy real estate and give you a split of our earnings. And that is a wonderful, wonderful way to build passive income, to build yourself an empire of cash machines over time. How many are we going to be able to buy? Well, it depends on how much money we're able to put together and what the economy does. And down here where I'm at in Northwest Florida, we've got several different niche markets that are available to us. Now, in some areas, you don't have this, but it just happens to be where I am, I do. Because I'm in a tourist area, I have short-term rental capabilities. I have also midterm capabilities, because this is a military community, and we have 6 military bases. And with that, not only do you have military families who are constantly in transition, but you have government contractors and who also come in here, and they need short-term housing, 3 and 6 months at a time while they're in transition. You also have people like the traveling nurses and different things like that, where they come in on a short-term contract. So we've got midterm. And then we have the traditional long-term of people who they're not going to buy a house, or they can't afford to buy a house, and they need a place to live. And so something new that I am adding to our area that we are really, really short on is that short-term, the midterm and co-living, because our rent is absolutely outrageous in this area right now, as it is where most of you live. You're probably thinking, how on earth are they able to get it? Well, you don't have a choice. It's supply and demand. So when rent is so high that people can't afford it, you start getting the co-living situations where families are moving in together. And that doesn't mean, like parents and their children or grandchildren. Now we've got families moving in together to save on expenses. And so that is becoming really popular. And that's going to be a thing. It's already going on in some of the urban areas. And so for investors, we can make the numbers work when we do that. currently for a regular traditional rental, unless you're doing fix and flips, which we are not. That may come a little bit later on down the road, but right now I see a huge need for this co-living going on. And so we're buying turnkey properties. So that means we're going to be spending a little bit more up front. They're all furnished, fenced in yards, nice, beautiful homes where anybody would be, thrilled to live there. And somebody could move in within 30 days. And that's where we're going with this. So anyways, if you would like to learn how to become a silent investor, you need to reach out to me as soon as possible, because we've got a new cohort starting this month. Today is January 31st, and tomorrow is the 1st. So we're going to start our first cohort in February. And as soon as we gather enough cash to make our offers, that's when we make our offers. So everything is paid for cash, so we don't have a mortgage. And, we don't have to have fear of somebody coming in and taking our homes. So that's what I've got for you today. Again, a little bit of economics lesson and how that pertains to you and why that's important. And you've got to get your income up where you can beat this inflation. You're going down to the grocery store and you're seeing how expensive things are. You're probably not able to buy as many things as you was last year. And so in order to do that, you've got to increase your income. And one of the ways to do that is to start building an empire of passive income machines. This is Nancy Gaskins, sowing seeds of financial hope and entrepreneurial opportunity in communities around the globe. Be sure you check out my other content on my YouTube channel, Passive Income Generators, or you can also find it in my name. Click that subscribe button and you'll be notified every time I drop a new video. Have a great week.